Hi, guys. Welcome to the How I Raise It podcast, the show where you get an inside look at how real entrepreneurs raise capital for their businesses. I'm your host, Nathan Becker, and today's episode is with Abhishek Nayak of Appsmith, an open source, low code platform for developers that just raised a $41 million Series B. So, we're going to talk about how he did that. He was also previously a VC at Accel India. So we're going to talk about the India versus USA startup scene. And we also get into his detailed tips for engineering growth without paying for marketing. So lots of good nuggets in this one. If you're tuning into this podcast to learn how to raise capital for your business, I've created a super valuable free welcome package for you. It includes a list of 2,500 investors who don't require a warm intro, plus 200 questions that investors are going to ask you. Really going to help you get ready to raise money. To get instant access to that, click the link in the first comment. While you're there, please leave us a nice comment what you like about this episode or this show in general. Last but not least, if you enjoy this conversation, think someone else would too, please share it with them. Hit that subscribe button to get all our latest episodes. Thank you, and sit back and enjoy this chat with Abhishek.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite.com. Today I have Abhishek Nayak of Appsmith coming to us from India. How's your day going?
Really good, Nathan. Thank you for having me on this podcast, and I'm excited to talk to you about Appsmith and my fundraising experiences.
So it's 9:22 in the morning in California. What time are you calling in at?
It's 9:52 p.m. Here, so like late evening.
I like the dedication. I don't think I could do an intelligent podcast at almost 10 o'clock at night if I had to. So thank you.
I hope I do well.
I'm sure you will. Awesome. Let's just jump right into it. What is Appsmith?
So Appsmith is an open source project that's used by developers and companies to build all sorts of custom applications. These are applications used by customer support teams, marketing, operations teams, really anybody and everybody inside a company who needs a custom application, maybe wants to replace Google Sheets with an application or wants to automate a process. They end up using Appsmith to build everything that they need.
And so is this aimed at people like myself who are, I'm a finance guy, I can't code to save my life, but I still want to build stuff? Is it aimed at me or developers to help them do a better job?
So it's primarily aimed at developers because you do need a little bit of experience with coding and you need to understand database as well to use this. So you might consider this as a low-code product or a web framework. That's the way we think about it. So most of our users tend to be professional engineers.
And what's the quick backstory? Where did you come up with this idea? Why did you build this company? Yeah.
So this actually was originally thought of by my co-founders Arpit and Nikhil, and the idea originated from a previous startup of ours that wasn't working out that well, so that startup was a game, and we worked on this game that went viral over a short period of time in India. We hit like 1 million plus downloads in 4 months, at about 120,000 people playing it every single day. And scale, a lot of problems and a lot of need for automation. And that's when Arpit was using some open source tools as well as some proprietary products to build all these apps that we needed, but they weren't good enough. And that's when Arpit started, who's my co-founder and CTO here at Appsmith. He started tinkering with this idea of building an open source project that can actually replace the tools that he wasn't happy with. Now he started working on this as a side project, but as he spent more time on it, and as I started spending some more time with him, I realized there was a chance for building a real business here. So that's sort of the story here. Now, my previous startup didn't work out so well, but I'm really happy that it led to the start and the rise of Appsmith.
You're not the first person on this show that has a similar story. I mean, we've had quite a few folks that, were working on a startup, it wasn't going well, but they learned something from that gave them the next idea, right? Or that fed into that. So that's always good. Very cool. And well, let's jump into the fundraising a bit here. How much have you guys raised and over how many rounds?
So we've raised 3 rounds in total, and across these 3 rounds, we've raised about like $52.5 million in total. Our first seed round was 2.5 mil. Then our second round was 8 million, and then our latest round, which we announced a couple of months ago, was 41 mil.
That's awesome. Congrats.
Thank you.
Let's go through it one by one. Let's talk about the seed round. Now you're in India, and I'm looking at a TechCrunch article. It says the company has folks spread across 16 countries, India, United States, Nigeria, which I have a few questions about as well. But talk about putting the seed round together. How did you approach it, and go for it?
Yeah. So my seed round was what I would consider a little bit non-traditional, because I was actually an entrepreneur in residence at Accel India, which is Accel Partners, but it's a fund very focused only on India. So it's an India-specific fund, a little bit different from the Accel US. So I was actually an EIR there for 9 months, and that's the period when I started incubating Appsmith's idea. My co-founder Arpit was working on it as a side project at a different startup, but I was in Accel India just working on a bunch of different ideas, but I ended up not finding an idea of my own, so I partnered up with Arpit to work on this. So I would say our seed round was a little bit more straightforward than I think most entrepreneurs go through, because Accel India was the investor in my previous startup as well, the startup that didn't work out. And they had invested 2 million in that. We ended up returning about 700K back to them when our startup didn't work out. So we had a previous relationship, and the partner that I worked with, Shekhar, he's a very well-known investor here in India who invests in a lot of B2B SaaS companies. So he was somebody who sort of understood the space that we were working in. He was a programmer before this, before being an investor. So he also understood the developer persona. So our seed round was raised by me being at Accel.
So, okay, you've said some interesting things I want to pick into a little bit. Accel India funded your previous startup, gave you $2 million plus or minus. You gave them back $700,000, but clearly they liked you enough to keep you on as an EIR. And then, I guess a couple questions here. You would think almost that if investors invested and you lost them money, that the relationship would be kind of ended, but clearly it didn't. So maybe touch on that a little bit if you can. And then what does it mean to be an EIR? Is that just where they're putting you in office, giving you a salary and hoping you come up with another idea? Maybe talk about those two different things.
Yeah, absolutely. I think working with Accel India has been a very special experience. The partners at this firm, they're extremely focused on truly being entrepreneur and founder friendly. They really live and breathe it every single day, and they tend to support entrepreneurs through multiple companies. It's not just me. I'm not a rare or a special case. They've actually done that with multiple entrepreneurs. And the reason being, I believe, is they believe a second-time entrepreneur or a third entrepreneur gains from their experience of failures and applies it again. But it also comes back to the fact that they truly believe succeeding with a startup is a longer term journey, and being an investor, it's a lot about having the right relationships. So that I think is a special difference, because I have raised from other funds in the past, and I think except for Accel and maybe YC, where my previous startup was incubated, I've not really gotten offers to come back again and raise from them. In most cases, they sort of discard the relationship after it didn't work out the first time.
That was what you would assume they would do, right? I mean, I can understand a fund wanting to back second time, third time founders when it worked out first and second time. Totally makes sense, right? But I guess, what do you think it was they saw in you that wanted to keep you around, if you can be so self-aware? Yeah.
I think one is the fact that I don't really give up. I think after my first startup didn't work out, I did have multiple opportunities to go work somewhere or join an investment firm. In fact, I did have an offer from Accel after I joined as an EIR to join them as an investor, but I did end up saying no, because I want to be an entrepreneur and I want to continue working on high growth startups. So I think that did make a difference. If I wasn't so persistent, I think it's hard for somebody else to back you, but I'm fairly persistent. So I think that definitely made a big difference.
Excellent. And then back to the other question I mentioned about what does it mean to be an EIR? Like, what's the sort of role or what does that mean?
So EIRs at most funds are different, and they generally don't have a job description. So what you do get is, like you said, you do get an office, you do get a salary, and then it really is up to you to make as much of it or as little of it as you want. I've seen EIRs succeed very early on. They've just spent a couple of months in and they find an idea. Well, I've also seen EIRs who spend a year, maybe 2 years, and then they realize they haven't found anything. So it totally depends on how much you make of it. In my case, I was helping existing portfolio companies of Accel, but I was also helping them look at new deals. I was sourcing deals for them, and I was meeting entrepreneurs who were pitching to Accel. So in my case, it really was half and half, helping portfolio companies as well as helping existing, rather new investments, but also spending some time on my idea. I would say so I spent 9 months as an EIR, but in the first 3 months, I didn't really do too much about finding my own idea because I was so tired from working on my previous startup. I just, wanted to take a break and just have a change of scenery and a change of pace. So the first 3 months, I didn't really do much except for just absorb and understand what does it mean to be working at a VC firm. How do they evaluate ideas? What is it that they do differently that makes them succeed versus other funds that I know? So that's what I spent my first 3 months on. But I quickly realized that I wasn't passionate about investing. And I realized I need to start working on my own ideas. Otherwise, I might just end up spending a lot of time learning about investment, but not being successful at doing my own startup. So after the first 3 months, I mostly started focusing on finding the right idea. And it took me another 3 months to realize that the idea that my friend Arpit, who was my co-founder at the previous startup, was working on was the idea that I should go work on, because he just had so much passion and commitment to that idea that I knew that he was onto something. So even though I didn't find my own idea, I actually found conviction to work on somebody else's idea.
Yeah, no, I like it. It's interesting because I think a lot of folks think of becoming an investor as the end game. There's this dream of becoming an investor. And I mean, frankly, it does seem to be an easier job than being an entrepreneur, which is really, really, really hard. I guess, what was it? What are some things you didn't like about being an investor?
I think the first thing was just the number of meetings that you're in. You're literally spending your entire day meeting new entrepreneurs or meeting your team members, and that's majority of your day. So that's something I didn't like. I like creating. I like making things. I like working on one idea at a time. That was the second thing. You have to be excited and passionate about many different things at the same time. I found that really hard. It's easy for me to be excited about one thing and go all in than be invested in understanding about 5 to 10 different things. I feel investors can sometimes be closer to academics in a way than closer to being an entrepreneur. Because as an academic, I feel you have to just toy with so many different ideas and be willing to have 2 or 3 of them in your mind at the same time. And I just didn't feel comfortable doing that. The third thing was, as an investor, your job is primarily to say no. At a place like Accel, for a Series A round, you might, as a partner, you might only do 1 deal or maybe like 2 deals at best in an entire year, which means everybody else that you're meeting, you're just saying no all the time. And that really got to me. It tires you out very quickly because it's emotionally painful to say no to somebody. I know it's even harder to hear a no, but I can also tell you it's real hard to keep saying no because you're breaking hearts and you're making it a lot tougher for an entrepreneur who's out there working and giving their heart and soul into it. So these were the 3 things which told me I would probably not be a great investor. So I didn't want to, spend too much time working on something that I knew I wouldn't enjoy and I wouldn't be very good at.
That's interesting. The fact that I never really thought about that saying no constantly, which is a VC's job. I mean, literally thousands of times a year, you're telling founders no to their dream. That could be pretty emotionally draining after a while. Very interesting.
Yeah.
Let's talk about raising capital in India versus the USA and some of the differences. And take that question any way you want.
Sure. So there are a lot of differences, primarily originating from the fact that India is a more immature ecosystem, which hasn't seen too many venture successes. I think we've seen a few now in the last 5 years, but it's nothing compared to what investors have seen in the Valley. So a lot of the differences originate because of that. So first is, in India, most investors don't have to work too hard to build a pipeline. Most investors have deals walking through the door, and the best investors end up seeing almost all the deals that happen. That's the reality. That's not the case in the Valley, where I feel investors just work a lot harder to build a pipeline and meet new entrepreneurs. And because of this, the investors in India can come across as a little more lazier, I would say. I mean, it sounds negative, but I would say it does feel like that, because you can walk into meetings where the investor, even though they're talking to you for the second or the third time, they haven't done enough research on the market. Versus, I've seen that in the Valley, if you're doing a second or a third meeting with somebody, they've sort of understood your market a lot better. They might have spoken to a customer already, or they've lined up conversations with customers or potential customers. So that's the second area that I've seen being a little bit different. The other third major differences in India, the investor and the entrepreneur relationships are a lot more warmer and a lot more closer, I would say. It's a lot more relationship driven.
Sorry, in India or US?
In India. For example, like, you might end up talking about family, you might end up talking a bit about how your life was like, and just learning a little more details about the investor that you're talking to before the deal goes through. Versus in the Valley, I've seen it's a lot more transactional, a lot more business-like. You might have been working with this investor for a while, but you might not know anything about them at all, because it's a lot more transactional. So that's another difference that I've seen. Then I've also seen that in India, the average investor, to be honest, is, in terms of IQ, is probably higher and better than the investors that I've met in the Valley. This is not a what's the word? Like a negative remark here, not a slam at all. But I think it's just the fact that there are so few VCs in India, and it's so hard to become a VC in India, that just the average IQ of people here who's an investor is just a lot better. I think I've had conversations here which are just a lot more intelligent than with some investors in the Valley who might have been very successful. And I think in India, it's just a lot harder to be a successful investor, because you just don't have too many successes. So I think in that sense, people actually have to work a lot harder, and they have to see a lot more deals so before they succeed. Yeah. So these are the sort of differences. There's a lot of pluses and minuses here. The common thing that I've seen is that in both India and the US, investors are very, very, at least the best investors, they're very driven by investing in ideas which are new and things that are unique in the market. May not be new in the traditional sense, but you're definitely trying something novel, or you have a novel spin on an old idea. So that's common. In India, people might look at the market size a little bit more than they do in the US, but both of them still do care about the total addressable market. But I've seen that in India, people have often been burnt by funding a product which was in a smaller market, simply because the Indian economy is not that large. Like in India, if you funded a company like Allbirds, something that makes shoes, you wouldn't be able to make a good return because it's such a small market. But you can do that in the US. So in India, people are a little more careful about the total addressable market. But when it comes to B2B or SaaS products, they're sort of the same, where they're not necessarily always looking at TAM with such granularity as as you would expect with a consumer product.
All very interesting stuff. Would you say kind of one of your points was about more relationship driven in India? I feel like in the US, in Silicon Valley, there's a bit, okay, yes, it helps if you went to Stanford or Harvard because that plugs you into the alumni network and stuff like that. But there's also 10,000 success stories of people who came from Iowa or came from Poland and Russia and found their way here and they built something and were able to attract venture dollars. Like, it kind of doesn't matter what your history is. If you've done something cool, unique, that people like, you can probably raise capital. Now, my question is, in India, because of the sheer number of people, does it really matter a lot, like what university you went to? Like, only IIT grads are getting funded, or even does caste play a role? I don't know if that's an appropriate question to ask or not, but I'll ask it anyway. Does it, like, do those things kind of play a role?
I think university a little bit, for sure, but also the companies that you worked at in the past, that also matters. And caste, not really. The thing is, specifically about the universities or workplaces, I think those things are similar to what I've seen in, even in the US, where if you have worked at a cool startup that grew really fast and you were one of the early team members who scaled with the company, you're more likely to get funded. When it comes to universities, I think the difference between the top universities and the universities that are not so well known in India is really stark. And what that means is, like, a place like IIT might produce 8,000 to 10,000 graduates a year. And you can assume that half of them understand what startups are because they just have a lot more exposure. Versus the average university, you might only have a few percentage of people at the top who are interested in startups and they're interested in being an entrepreneur, versus the rest of them are mostly looking for a job. And so you might invest in them later in their career after they've worked at a startup and they've realized, oh, so this is how a startup actually works. Because the whole startup culture is still very, very new in India.
Yeah, interesting. So all the differences are quite interesting. What tips do you have for, I guess, up and coming Indian founders to raise capital? Do they need to go to IIT? Is that tip number one? Get into IIT? No. I mean, yeah. What advice would you give, like, start founders in India specifically?
I think the main advice I would give is what YC tells everybody is make something that people want. I just don't think there's a simpler way of explaining what defines the success of a startup than just building something that people want. In India, I often see entrepreneurs building some things because it's cool or because they think it's more likely to be funded by an investor. And that's just such a terrible idea because the smartest investors are always looking for early success with customers, early growth, early retention, and that's what they're looking for. They're not necessarily looking for market trends. Now, some of them might look at it, but it's definitely not the best. The best ones are always looking for evidence that there are real customers who like your product. So in that sense, it's not so different, and it is boring advice that you just got to make something that people really like. The difference here is entrepreneurs overestimate the amount of work that they need to put in to convince an investor. I think that's something that does happen in India, where they look at investment as such a complicated and such a rare story that they feel they have to work specifically for that investment. But in my experience, I've seen if you build a business that's doing well, you're inevitably going to get called by an analyst or by a VC partner if it's doing really, really well. But there's just such few deals in India that if you begin to grow fast and you begin to do well, people want to meet you, and that's probably like half of fundraising, which is just meeting the right investors.
In some of the notes we had over email, one of the notes was, the growth of the quality of your product should outweigh the quantity of your fundraising and advertising. So maybe you touch on that. What does that mean?
Yeah, for sure. I believe most startups should have mostly free growth. What I mean by that is 90% of your growth should be either inbound or should be where people are talking about you, through viral growth or through SEO or other methods. Maybe only like 10-20% of your growth, especially in early days, it should probably be like 10% or less, should be growth that you've bought, that you've paid for. It's really easy to start paying for growth in the early days. It's dead easy because it feels like it's in your control. It feels like it's going to take you a few minutes of work instead of, months of work. So that's something I tell every entrepreneur that I advise, that if you're already thinking about advertisements or paid marketing and you've just raised a seed round, it's very likely that you're going to have a shitty business. Taken that, it's going to take you longer and you will not meet your internal growth goals when you're working on increasing inbound, but that's okay because you're going to fundamentally build a really, really strong business. And that's something I truly believe in because I've practiced it in all my 3 startups. And for example, in this startup, we have nearly 10,000 companies that use us every month. And I have never sent a cold email or I've never really advertised. We've sponsored a conference and we've sponsored some YouTube videos, but that's probably less than 0.1% of our users. And we have Fortune 500, Fortune 100 companies that use us. So I do know it's possible. Now, at this stage, we will probably start doing paid growth and paid marketing in the next few quarters. But we've actually managed to come so far without ever doing anything outbound or anything that's growth focused, primarily because we've been so focused on making our product work really well. And our product is complicated. So that's why it's taken us 3 years to get to a stage where we're finally seeing some growth. And now it makes sense for us to invest in paid growth. So in the early days, I just encourage entrepreneurs to just focus on building that inbound method or building something that I call as a free channel where you're not putting in money every single day.
Yeah, that's interesting. It's totally logical what you just said, right? If you raised $1 million, put it into product, making sure your product is really good and the growth will kind of organically happen, people talking about it, word of mouth. Yet at the same time, I feel like things don't necessarily always sell themselves. You have to build awareness for what you're doing. It's great when the viral word of mouth happens, but it's a tough balancing act. I've seen the other side too, where your product sucks, yet people are spending lots and lots on advertising and marketing so they can hit their metrics for the next venture round, so on and so forth, right?
So I want to just clarify. I don't mean you should not do marketing. You have to do marketing. What that means is write a lot of content, create a lot of content about the problems that you're solving, help people find you on Google, what's called SEO. So you have to do all of that. That is absolutely necessary. What you should not be doing is paying for growth, advertising, or paying for outbound when you haven't figured out these inbound channels that well. So that's the difference. I totally believe in marketing. I don't think a product can sell itself if people don't understand it, people don't know how to use it. And that's the content that you have to write, and that's the marketing that you have to do. You have to tell your story. But I do believe the world is so large today that if you tell your story enough number of times, you're going to find people who connect with it and are going to show up and buy your product. And then you can start spending on outbound or paid advertising to find more people like them. But if you're spending too much money on finding early customers, then that's the problem.
That makes sense. So you guys have grown to 10,000 customers or companies using you on not much marketing spend. What were the top 3 things you did? You kind of mentioned them already, but just summarize your top 3 or 4 marketing approaches.
So the first thing that we did was create a lot of content to help people understand what problems the product solves. This is what you would consider as top of the funnel content, trying to reach people who have the same problem that you originally tried to solve when you started building it for yourself. So talk a lot about the problem. That's one. The second thing that we did.
Sorry to interrupt. Are these blogs or are these what?
So these are blogs and YouTube videos. We invest a lot on YouTube as well. So it's both blogs and YouTube videos. The second thing that I recommend is making it dead simple for people to understand how to use your product. Because in the early days, your product inevitably sucks. It's too complicated. It's not so easy to navigate and figure out how to use it. And people resort to doing more demo calls or doing onboarding calls, while I believe you should just be creating content around how to use the product. So even if people find it a little bit difficult, they're at least going to continue using it because they know they have support and they have documentation that's available to help them use the product. The interesting thing is, over time, this documentation also leads to top of funnel content, top of funnel traffic. That's the interesting thing, because documentation ends up covering the same problems that the product is trying to solve for customers. So that's the second thing that we did. The third thing that we did, and this is very relevant to open source and because we are a developer tool, is we built a community of users who help each other out when they run into issues. And this community has started very, very small, but today is about 5,000 people. And it's relatively small in comparison to a lot of other communities, but it's become a true force because they actually talk about how to use Appsmith. They create use cases of Appsmith and they talk about Appsmith to their colleagues, their friends. And this community, I expect, over time is going to be a big driver of our growth. But these are the three things that we did.
I'll let you go in a minute or two because you have a company to run, but let's talk about number 3 there for a little bit. How did you do that? How did you, first of all, what's the format of the community? Is it like bulletin boards or something else? And second of all, how did you actually get people to participate in it?
So first, we actually tried, we have a forum, which is like a bulletin board. We also have Discord, which is exactly like Slack, but it's very easy to join as an outsider. And third, we also used to have a third forum, which was on GitHub. So we tried all three because we did not know what would work, and we decided to just try all three out. Today for us, Discord works really well, and the bulletin board on our website works really well. We ended up shutting down the GitHub forum because it wasn't so easy for us to manage and use. So we just did these two. And at the very start, most people who were joining the forum and the online Discord community were only looking for support. They just had bugs to report and they just were looking for help. What we did do was, as founders and early team members, we kept replying to every single message within 10 minutes, which is a crazy thing to do because we had so many users in different geographies. But that early dedication and that early commitment to replying to people quickly convinced the early folks that, hey, this is a forum that's worthy of spending my time on because people reply quickly here. And this also convinced other users to try and reply quickly to other people. Now, over time, our own individual reply times have fallen. I think today we reply maybe within like 2 hours or 3 hours, but a user still gets a reply within 30 minutes because of a community member. So in the early days, it was just grinding it out, just staying up late for ridiculous reasons and for replying to really simple messages. But that did help set the ground for a good, thriving community. And today, of course, we have a full-time community manager who focuses on ensuring that people who join the community have the right expectations, but also commit to helping each other out and are using the right forums, the right channels, so they're not creating too much noise. And we make it easy for them to be recognized and also contribute to Appsmith.
What? This is great, and sorry to keep bugging on this, but I think it's an interesting topic. How do you incentivize people to participate and answer, for example, bug questions that maybe typically you'd expect the company to be answering? Yeah.
There is no incentive. We do ship swag to some of our users once in a while, but what we've noticed is the users who've gotten help from the company, they are the ones who are more likely to help other users because they understand. Now, ultimately, Appsmith, a majority of our users are free users because it's open source. It's a developer tool and it's open source. So that's something to keep in mind. So most of our users are quite grateful that there is something like Appsmith, and they're really friendly. So they help other users out, for no reason other than the fact that they were helped by somebody else and they were helped by the company. And developers tend to do that. That's what has been very interesting. They're online a lot and they love helping people out.
Do they get any kind of like reputation score or any stickers and stars next to their name for being a top helper or anything like that?
Not yet. We need to do something about it, and that's probably something we'll do over the next quarter or so. But like I said, we used to ship swag. But the funny thing is, some of our most proactive members have never gotten swag from us. So there isn't that much connection between the incentive and what they do.
Sure.
That's the weird thing. Yeah.
Funny. All right, very good. I will let you go here. Any last tips, tactics, advice you'd like to give to fellow entrepreneurs, or advice you would give your younger self? This is what I always ask. Advice you would give your younger self if you were doing this all over again?
I think I would give maybe like two pieces of advice, I would say. The first piece of advice is to look at investors as part of your team and not to look at them as your bosses. Even though investors do have the right to fire you, you have to look at them as your team members who you've recruited. They should have access to the exact same information that your team does, nothing different. So that's really essential. As a first-time entrepreneur, I used to think about managing expectations and managing the investor relationship, and that complicated my life because I used to treat them differently. But today I treat them just like I would treat an executive or an employee of my team, and that really helps. So that's the first thing. The second advice I would give, which is relevant to the fact that it's a terrible time to fundraise today, is that some of the best startups emerge when funding is scarce. And the reason for that is most entrepreneurs give up when there is no access to funding. And that's amazing for you because you can truly build a product that doesn't have too many competitors. And when the market turns around, which will happen, no doubt about it, you will be able to fundraise and you're going to take off like a rocket. So if you're thinking about not doing a startup because it's financially a bad time, I think that's a mistake. You should do a startup when it's terrible times economically, but it's going to be great for you.
I like that advice. I think that's wise. It's kind of like the investment advice of, be buying stocks when there's blood in the streets, right? And selling when it's all frothy. I mean, it's the same thing. I think it's great if you start a startup during hard economic times and you're able to pull it off. You've got tough entrepreneurial muscle that you've built during that time. So I really like that advice. This is great. Thank you so much. If people want to learn more, appsmith.com. Any other social channels or anything you want to promote or plug here?
So I'm on Twitter. You can just search for Abhishek Nayak and you'll find me on Twitter. Otherwise you should definitely check out appsmith.com and see if it makes sense for your company.
Very good. Thank you, sir. Appreciate it. I'll go to bed now. It's late there. And thank you. This is really interesting, and good luck on the business, and we'll catch you after your next round.
Yeah, thanks, Nathan. Have a great day. Thank you so much for having me. I had a lovely chat, lovely time talking to you.
Yes, thank you very much. Appreciate it. Over and out.